Good afternoon, everybody. It's great to have you here. The session we've got today is trucking M&A trends, a recap of 2020 and a 2021 predictions. It'll be fun. A lot of really interesting, crazy times that we've experienced. And we've got two great experts here to help us talk a little bit about their experience and what they're seeing and some advice. Without further ado, again, trucking and M&A trends, 2020 recap and 2021 predictions. Good stuff, right? I mean, man, oh man, what a lot to talk about. And I'm really pleased to be able to bring Spencer and Eric to us today. A great team from the Tenney Group. They've had a long history of helping the industry through opportunities and challenges. They've been gracious enough to team up with us. We are going to do 4 webinars throughout the course of the year. This is the first in this series, so I'm super excited. So with us, we have Spencer Tenney, who is the president and CEO of the Tenney Group, and Eric Lamar. Eric is the managing director, and they've got a huge amount of knowledge industry-wise to share with us. So without further ado, I'm going to hush up. I will come back at the end and we'll do a little Q&A. But with that, I'm going to turn it over to Spencer and Eric. Over to you guys.
Thank you, Hal. Good to be with you folks. Again, Spencer Tenney of the Tenney Group. Just quick background on our firm, who we are and what we do. We're a merger and acquisition advisory firm that's been specializing in the transportation and logistics space since 1973. I'm a 3-generation guy. My grandfather was he drove a beer truck. He was a cab driver. My dad was a driver for a while. He was pitiful, got fired multiple times out in Dallas, and moved on to business ownership, consulting, and advisory. And it's just been a great privilege to together help a lot of business owners over the last 45 plus years through the process of business sales and acquisitions. So today, quite a bit on the table. I'm excited about getting into this content. And I'm going to introduce Eric here in a minute. But I think the main thing that I want to convey is we're going to talk about some of the highlights from 2020, some of the forecasts for 2021. No matter where you are right now, if you intend to acquire or if you intend to sell, it doesn't really matter. Why today, what we're going to discuss is why it's important is because no matter what you do or don't do, you're likely going to be affected by what happens in the marketplace, because every time some of these deals take place, it affects the competitive landscape. So I hope that today you'll get some takeaways, you'll get some confidence about how you want to participate in that, whether you want to be active or passive. But either way, we want to educate you so you know what's going on. So with that, let me introduce Eric Lamar. As Hal said, he's a managing director, very valuable member of our team. He's been very deeply involved in the last 3 deals that we've done in the last 60 days in the trucking space. Major players with names that you would recognize, but a lot of knowledge, maybe more charisma, and by the looks of that picture, maybe more haircut. Maybe it's time for another haircut.
Needs a haircut, yes.
Very appreciative of him, and I think he would agree that we really appreciate the opportunity to work with business owners in this industry. It's not like other industries. This is special, and it's a privilege to be with you folks. So Eric, would you kind of get us going, get us on the right track here?
Yeah, I appreciate it, Spencer, and wholeheartedly agree. That's our entire team actually has this conversation regularly. A lot of us could be in other places doing very similar things for other firms, but one of the special things about what we do is work 100% in transportation. And so that segment is very near and dear to our heart. And it's fun to work alongside the folks that literally keep the country moving. So, we're going to talk a lot. Spencer's going to spend a little bit of time here in a second talking some of the numbers, some of the data points around deals in 2020, which everyone tends to be very excited to hear about. I think it's really important information, but there's also components to M&A that don't get as much press, and I think are equally as important. Kind of setting the backdrop, the foundation. The best M&A happens when a buyer's need is met by a seller, and a seller's at the same time, the seller's needs are met by the buyer. So what we're looking for in successful M&A, mergers and acquisitions done well, is that both parties win. So that's successful M&A. And so we're going to get into how we see that happening, maybe what we saw as disruptors and changes in 2020 and what we expect to be continuing to happen in 2021. But I think, just a couple of examples. We had a deal that's within the last 2 years that very attractive company had 6 written offers on their company, and the ownership took a multi-million-dollar haircut on their financial outcome in order to secure the jobs of their people. And not only did they keep those folks employed in their town, that location by the buyer was grown probably 30 to 35% over the next 12 months. And so in terms of, when we talk about needs of a seller, it's not just financial needs. I mean, that's real. Retirement or legacy planning for their family, whatever the case may be, financially is real, but culture needs are real. And protecting people and legacy and clients is another component in the transportation industry that is just as critical to getting successful M&A done. And so, that's a good example. Another example that closed within the last year or so of the seller was excited to stay on, just didn't want to be the owner, didn't want to bear the 100% risk of the ownership. So was excited when the buyer said, well, will you stay for 3 years? Here's an employment agreement. Keep doing what you do. Get excited about it. Because he was on the outskirts of their density. And so him being a really strong advocate for their company made his company more valuable in terms of their acquisition strategy. And then the last example was a client that the buyer was a very successful buyer. Within the last year, was looking at multiple targets. Our client was just one of them. And ultimately they decided to pay a premium for our client because that client represented a platform that allowed them to get strong immediately in a service that they were not currently providing. So you'll hear the term flat platform. Our client represented a platform for this new acquirer, for this buyer, to be able to create an immediate service provision for existing clients that they didn't have before. So again, those are some backdrops of notable deal components in 2020 that we've seen. And the impact is people are taken care of, clients are taken care of, and then ultimately our sellers, the financial outcomes, they fund ministries or they build buildings in their counties that are needed, or there's all kinds of impact that happens that don't show up in Transport Topics or whatever the publication may be. And I think it's worth highlighting that those are very notable components. So let's look at a sample. You can find these if you went back and looked at different publications over the year. These are some of the notable transactions. I mean, you've got everybody from Penske to XPO. You've got first-time acquirers and acquirers that have done deals, left and right over the course of the last several decades. So in this group, you've got private equity type, private equity buyers as opposed to pure strategics, and also strategics that have private equity backing to them. So I think we selected these deals because as we get further into this content, we're going to allude to different types of buyers and different types of structures. And this list is a representation that it's not just purely JB Hunt as a strategic buying, or it's not just purely New Spring as a private equity buying. And again, there's this list shows you a very diverse type of buyer that we're going to allude to as we go forward. So Spencer, you want to take us into some of the stats?
Yeah, let's look at it. There's a lot of different third-party information that anybody can go out and, they are transaction data aggregators. Capital IQ is one that we rely on. And what their research says is that there was 89 total deals within transportation logistics. In reality, that probably represents maybe half, because this only represents what's publicly reported. There's a lot of smaller deals, maybe deals with most commonly 100 trucks or less. They're going to be the most common to kind of go below the radar of things getting reported. But still, it's a meaningful number just to kind of have as a reference point for us. And you see that there was 59 trucking deals that were reported, and then 30s that were more on the logistics side. So what we wanted to offer to this group today is a little bit of a peek behind the curtain of what happens in our office, and trying to get a little bit more of how to make sense of this, because there's a lot of things that are available as far as valuation multiples and things. And as Eric alluded to, that can be misleading if viewed at in the incorrect context. So what we have here to share with you is something that we think is kind of unique that we hope will be valuable to you. So what this represents is just a kind of a breakdown of offers and the source of those offers over the last 18 months. And so the first thing we're looking at here is the buyer engagement by type of buyer. And we're looking at for folks that looked at a teaser for us, which is kind of a blank description. They signed a non-disclosure agreement, which demonstrated us a certain level of serious interest to go explore a deal. So of those folks, all the people that we've engaged with, dozens of different deals that we've represented over that time, 55.95% were strategic. Now, when we say strategic, we mean folks that already have some type of investment in the transportation and logistics space, and they're trying to approach a deal to create some kind of synergy. That's what we mean by that. 32.14% of private equity without a platform. So that is people that you've probably heard, like even in the major publications, Fleet Owner, Transport Topics, of like, massive private equity interest increase. Well, that's true, and we'll elaborate on that in a minute. So we got 30.14% people that have no attachment to transportation logistics investments now, but are looking at our opportunities. Then we have 6.43% private equity with platform. That's like a New Spring private equity group that Eric mentioned, and then 5.48% of private investor, just a high net worth individual that, hey, the transportation and logistics, it sounds like something I could win in. I want to take a look at it. Though that's how that breaks out. So the next thing is the percent of total offers received by buyer type. And so this is an indication of interest, which is a less formal offer, or a LOI or letter of intent, which is a little bit more of a formal offer. So the way that this breaks out is 67.44% of the offers that our firm received over the last 18 months, they were from strategic buyers. The 20.9% were private equity with a platform. 6.97% were private equity without a platform, and then 4.65% from a private investor. So a couple of quick takeaways is that there's a disproportionate amount of offers that we're receiving from that group. Number one, if you add it up, it's roughly about 88% of the actual offers of who's really getting deep into the deal-making process and getting deals done. They're coming from strategic buyers or private equity buyers with a platform already in the transportation and logistics space. And why that's relevant is because from an execution risk, if you all are being pursued by buyers, just, you want to make sure that you're spending time with folks who have the track record to go the distance. And what we're showing you here is like, hey, there is a lot of interest, but the path to getting deals done is pretty narrow as far as who's actually getting deep in the process. So we move to the next slide, a couple other stats that we want to share with you that we think that it'll be helpful. And this has to do with the offers, all kinds of questions that we get internally, like, well, what's the valuation? What are the offers? And so this is an important part. So if we look at the way that the offers are structured, the total percent of cash in an offer is 68%. Total percent earnout in an offer is at 34%. Now, an earnout, some of you might be familiar with this, but an earnout is typically a deal structuring instrument where a portion of the total consideration is subject to future performance. And so the reason why that is put into place, or the spirit of it, is so that the seller has the potential to participate in the upside of the performance while allowing the buyer to be freed from all of the risk should the seller not deliver on that performance. So it's a little bit of like, hey, we'll share this risk. If you get it, great, we'll pay you for it. If not, then you didn't earn it anyways. So that's there. And then on the other side, the percent of seller financing in an offer, that's more of a fixed note over time, 28%. So if you break that out by buyers, on the financial buyers, in the non-strategic, 63% of those, the percent of cash in the offer was 63%, earnout in offer was 35%, percent of roll forward equity in the offer, 22%. So what that means, if that's an unfamiliar term, it's when the buyer extends stock in their business moving forward. So instead of giving them cash, we'll give you 22% of the value of the transaction in our business moving forward. And that's just a different way to structure a deal. But it's important for us to kind of like, well, how are deals getting done? This is how they're getting done. And then the last on the offers from strategic buyers and how that breaks down, we've got the percent of cash, 71%, and then 31% is some combination of earnout and seller financing. And so, the broader takeaways that we have here is that number one, just in terms of pure probability of getting a deal done, 80%, regardless of what's happening. Yes, there's a lot of interest from people that are not already in transportation that are getting there. But for now, a small percentage of buyer types that strategic and private equity back strategic, they're doing the majority of the deal making. So that's a major characteristic. And the other side of, as far as this deal structuring, 71% of the cash, it's actually the strategic buyers are offering more cash at closing than the people that sometimes people assume would be providing more cash, which would be your private equity groups that don't have a platform or just your financial investors. So some really interesting stats. And obviously we're happy to answer any questions from that in a little bit, but just want to throw something a little bit different at you that you can't get anywhere else. So let me move on to that next slide there, and let's focus on takeaways from 2020. As Eric mentioned, this was a year like no other. And so during our time together, we're going to try to focus on what was driving value, some strategy, deal structure, but also let's start with the biggest probably deal, which is this funny looking coffee cup right here, EBITDA. Some of you might know that one of the more common formulas for coming up with a valuation is applying a multiple to EBITDA, earnings before interest, taxes, depreciation, and amortization. Well, the joke in 2020 was we added a C on that to account for coronavirus. EBIT is just a function of just normalizing the benefit stream or the earnings so that people can look at one business for sale to the next, apples to apples. And so
it was a joke, and then it became not a joke.
Yes. It was kind of bizarre from our world when you had all these irregularities, but people were because it was such a universal impact for buyers and sellers, every transaction that we were part of, we had to normalize it. There was a temporary dip in performance, everyone accepted that as like, hey, that's non-reoccurring. It's not to say that we're going to ignore it, but we're not going to be punitive about it in the way that we address deal making with the seller. And we'll get into that here in a second.
Yeah.
But that was one of the major takeaways as far as just an uncharacteristic amount of fair-mindedness in the way that people approached this non-reoccurring spike in sometimes revenue and sometimes expenses. Another trend or takeaway of 2020, talk about valuation, top of every mind. So what happened? We're on the conversation. We were talking with Hal right before we got in here and got into this a little bit. In general, valuations went up, and for three reasons. Number one, the supply of available companies to purchase dramatically went down. And a lot of this had to do with COVID. When COVID came late February, early March, it created winners and losers, but it created confusion and stress for all. So many people, they were having the best year of their life, but they were so overwhelmed from a workload, they couldn't possibly run a process at the same time. So they pumped the brakes and didn't enter the market as on schedule as they had planned to. So what that did was shortage of supply, and that's simple supply and demand economics. And then the other side of that is that we had major amounts of dry powder from private equity. They have mandates. They have to go deploy this cash. So they had to get it done. When you add that to a short supply, you had this hyper competition of folks trying to get deals done. And then you combine low interest rates with that. It was kind of wild west, to be honest, with the deals that we had that were in play. And so what does that mean? Does that mean that people were just paying stupid money? Not necessarily. So just in context, if somebody was valuing a business maybe at 4 to 4.5 times EBITDA to get to a purchase price back in January or February, when the following 9 months, as that pool of available companies to purchase got really small, that went to more like 4.5 to 4.75 to 5. So it's not just crazy, but it's a meaningful amount. I'm talking about millions of dollars in some cases of what that meant for sellers that were still in the conversation during that strange period. And so really interesting. And of course, when capital is as cheap as what it is, it just made for an environment to help buyers and sellers work together to get deals done. It's cheap for buyers to get it done, and the cost of paying the seller that if they're using debt as an instrument to get it, when you have record low interest rates, it's not as consequential to the buyer to help a seller get where he needs to be to get the deal done. So those were the major factors as it relates to valuation. And so the drivers was another big one. We had a deal that we closed in Michigan, and we had a deal that was just highly disruptive in the auto parts hauling industry, but had excellent drivers that were highly valuable. And irrespective of what was going on, the performance of the business, which had a history of being, phenomenal, but during this time was struggling because the buyers, because the drivers were so valuable to the buyer, they were able to strike a deal that was a win-win for everybody. And the buyer ended up keeping all the drivers, keeping all the staff, and it's a really great success story. But drivers, I mean, that's a major component of the storyline for 2020, because no matter what, to go execute growth initiatives or whatever, it's all theory unless you have the drivers to execute. So that continues to be a major driver. And then this earnouts, as far as the shift in application, earnouts are always a part of the deal. They can be a highly effective instrument to get deals done. And what took place in 2020 is that their role evolved quite a bit. And what it did was I alluded to this a minute ago, was just it provided a different level of engagement from both buyer and seller to get deeper into the process, to find out, calculate, and identify what are the real risks, when am I going to be exposed to those risks, and then how do we address that so that we can still get a deal done. We're going to walk through an example here in a minute to explain how that played out. But as far as takeaways, those three things are pretty major. So for context, let's give an example of a deal structure influenced by COVID. So we had a deal, probably not unlike the size of your business based on what Hal explained as far as a lot of the profile, probably very similar in size and shape. And this deal was $11 million in total consideration and asset light. So you look at this deal, the proposed deal, and what they actually committed to was $4 million cash at closing with a $7 million earnout. Now, if the story stops there, you're like, nope. It's kind of like Shark Tank. I'm out, right? So not doing that. But here's why that worked. There was a major disruption in the business. And rather than the buyer just saying, I'm out, he said, okay, there's weird stuff going on in the transportation world right now. I want to understand what's happening there. So they got together, leaned in, engaged, and find out what the risks were. Okay, we defined it. We also identified, okay, that is very specific and non-reoccurring. And also here are the signals that convey that we're already back on track. And here's when we're going to be totally back on track. So because the seller and the buyer took enough time to learn about what was going on there, both the upside and the downside and the risk, they were able to kind of box in the risk associated with transferring ownership. And they were able to arrive at a deal structure that was fair for both parties. So the buyer put $4 million down in cash and then put $7 million in an earnout. They figured it would take 8 months for the seller to demonstrate that the business was back on track, no more and no less, because they communicated well, they identified that. So really the seller was, what control do I have to go deliver that? The buyer says, you have total control. Continue to run the business. You have access to all reporting, you have everything. So there really was no risk to the seller. He said, that's why he said, yes, I have total control. I have all access to the reporting. I control the mechanism. So there's really no risk because I know this is about to happen because I know my business. So instead of it really being an earnout, it's really a cash deal with 2 installment payments separated by 8 months. That's all it was, based on the actual real risk to the seller. In addition to that, we're able to help that seller take the cap off it. And he actually did better than what the projections were, which allowed him to net another $500,000 in cash. And again, the differentiator is outside of COVID, this doesn't happen because you don't typically get that type of engagement from both buyer and seller to spend enough time to isolate that problem, the risk associated with, and how to deal with it. But it's a great case study to demonstrate, hey, if buyers and sellers will take the time to do this, a lot of great deals can get done. It doesn't have to be this dramatic. This is kind of an exaggerated form. But moving forward, I think that you will see a lot of deals that it's, as long as there's shared risk moving forward, a lot of great things can happen for both parties. So a couple more takeaways. Lamar?
Yes. So, one of the things that we've alluded to a couple of times, but we want to kind of spend a little bit more time on is some of the changes we saw in the buyer landscape. I was part of putting together a panel earlier this month for a different organization. We were bringing together bankers and private equity groups to ask this question: what happened in 2020 and what's going to happen in 21? And I asked one of the private equity guys point blank, what happened in your firm? And he said, we threw the book out. And I was like, okay, well, help me understand what that means. And he said, well, everything that we've told you for the last 3 years, well, we only want to look at this segment, and we'll only look at, things above this amount of EBITDA, and we'll only do, whole, takeouts, not minority stake. That we did all of it. Like everything we've said we're not going to do, we did it last year because we were trying to get deals done. And to Spencer's point, there's some extra pressure points on them to deliver return for their investors. So the question then turns, and we'll get into this, but what happened in 20 that we learned from and we can expect in 21? So what we saw, the difference in them throwing the book out, there were some deals done that we wouldn't have expected to be done. But what we did see as kind of a macro change was a lot of buyers changed from being segment specific to diversifying into different segments. So we had a call a couple of weeks ago with a traditional 100% dry van company, large company, most of us know well. And they essentially were upset with us that we hadn't shown them one of our refrigerated trucking deals. And we said, you don't have any reefer. And they said, well, yeah, but we want to buy reefer. We want to diversify into reefers. Okay, well, that's good for us to know, because that's a complete change from all the conversations we've had for however many years we've been having. So that's, diversifying into different segments. Something I think that's particular to this group in the intermodal drayage space. We've sold 3 deals into the final in the final mile space, which is the very end of the supply chain, whether it's to the residential component or to the commercial component. The intermodal drayage, in terms of the state side part of the supply chain, is the other end. And what we're seeing is folks that are in the middle, traditional truckload carriers, are interested in owning more of the supply chain. And so what we saw from our clients is they moved kind of toward the consumer on the supply chain in the final mile. And we're seeing and hearing a lot of interest over the last 18 months of buyers saying they're interested in intermodal drayage. They want to own that end of the supply chain as well. And so, I was on the phone with some friends in the industry yesterday, and they were asking that question. And is there an uptick in desire or interest in intermodal? And the answer is absolutely, 100%. Folks that have no exposure to intermodal or drayage, or have some intermodal drayage exposure, are interested in growing that exposure and growing their footprint in that segment as we move into 21. Other changes we saw in buyer strategy was folks that had been 100% IC or owner operator previously are looking at W2, companies that are completely W2 drivers. And then I also mentioned taking minority stakes, not just majority stakes. So, growth capital type of investments where they're buying a portion of the company to help the company grow. So those were some buyer trends and some strategies that we saw change. Trends in general for a deal getting done. One of the things we saw was, because of the uncertainty early in the year or midway through the year, we had folks that were doing Q of E components of deals, quality of earnings. They couldn't get them. They just couldn't do them because their firm had shut down for a certain period of time. So some of the components took longer to get done. For just natural components to a deal getting done were taking longer. There were more third-party consents. Anytime there's uncertainty from financial institutions or leasing institutions, they want their risk documented better. And so there was a much more higher level of threshold of need for third-party consents. There was a higher need for attorneys, and we've got some great partners on this call, actually, firms that we've worked with to help deals get closed that, pipe up right now and say, yeah, it took us longer because there was remote, or we had, there was a week where nobody was doing anything, and then there was a week where everybody wanted. We joke, it was like Labor Day. People started doing all the work that we had taken off Memorial to Labor Day off. And then we wanted to do everything from Labor Day to Christmas that we had taken off the middle part of the year. So, attorneys and accountants and insurance broker, advisors saw an incredible amount of work that they were trying to juggle in the second half of the year. To Spencer's point, there was just pent up energy that when there was so much uncertainty, nobody was doing anything. And then now everybody wants their stuff done first. So those were more hurdles to get the deal from LOI, from the letter of intent, to closed that we saw in 2020. So we'll, hopefully some of that will get ironed out moving into 21, and we'll look at that going forward. These are just some notable quotes that we heard this year that we've never heard before. A private equity contact of Spencer's called him after hours and said, "Hey, what do I have to do to get to the front of the line on this deal?" And Spencer's like, "You're already talking to our team. You're in the conversation." He goes, "No, like what else do I have to do?" And so I think for us as a firm, it told us when our buyers have identified something they are interested in, they will pull out all the stops. And so we saw that in 2020. We're continuing to see that in 21. The second one, 50% dip in performance, no problem. We get it. If you've heard us speak before, we've used anecdotal evidence of anytime we're in the middle of a deal and there's a dip in EBITDA, it's a concern. The buyer has a concern. Sometimes everything halts. That was not true this year. People recognized there was huge disruptions, huge hits and huge spikes. We were talking to Hal earlier. We saw, like in the transportation industry, we saw a Great Depression and a great recovery all within about 6 months. If you talk to somebody in April and then you talk to them in August, their revenue could be 180,000% different from April to August. And that's just how dramatic it was. And so buyers, to Spencer's point, reasonable buyers are reasonable. They're willing to listen and willing to work through things like that. And then the third one, we need to push the closing 2 weeks. The entire office has COVID. Oh, we had real deals that did no work for 2 weeks because some segment of the deal was totally shut down. So, hopefully we never experience some of those dynamics. But our hope, and we're going to look at this going forward, our hope is that some of the things that we experienced in 20 will help us get better moving into 21. And so Spencer, help us move into 21 in terms of kind of forecast and what are we looking at?
Yeah. So what's going to happen? Number one, we talk about this deal flow normalization. And what we're going to see is about 12 to 15 months of traditional deal activity squeezed into the first 6 to 9 months of 2021. So it's important to understand, okay, the world's not going crazy. It's just more of a normalization of what should have happened last year and got pushed into this next year. Now, what is going to happen? I mentioned the supply and demand. Right now, there is a unusual amount of leverage for good companies that are available to purchase. So as that supply of available companies to purchase normalizes and increases in quantity, so will the demand will decrease for those companies. And so you'll see the valuations normalize as well. So the takeaway is for those that are kind of on that fence, just be aware of that. As far as that's just simple supply and demand economics. Once the supply normalizes, so will the valuation, so will demand. So the next thing is just new risk. I think that we've talked about the diversification in general. There's a tremendous amount of sensitivity to the new risks that have been injected into the market. Part of that's COVID, part of that's politics, taxes, whatnot. So with that, it's going to bring greater attention to the reps and warranties insurance as a part of dealing with the risk post-transaction. So just keep an eye on that as an instrument that you might want to integrate into a deal. The cost of these is getting much more accessible. It's just becoming a way to help get deals done. So I expect that to play a greater role and expect more insurance solution providers to make that available. That's a whole subspecialty. Won't spend a whole lot of time on that because we got to talk about taxes, your most favorite thing on earth to address. So taxes, they're not red, they're not blue, they're just true. That's the way it is. And so the Biden's proposed tax plan offers some new changes for us that you need to be aware of. Don't know if this is going to become law or when, but I believe that the Biden administration has the mandate to make it law whenever they want to. There's a lot of nuances. I encourage you to get with your tax advisor to go over the details of this. The one thing that I want on your radar is the proposed change to the capital gains, because that has to do with deal making the most. And so the proposed change on the table is taking what is now 23.8% and then changing it for everything above $1 million in gain to ordinary income, which is effectively up to 43%. That's a lot. So to quantify that, on a $50 million purchase, that's basically another roughly $10 million in new taxes that this proposal would not be there. In my experience, I've been doing this, my family's been doing this, almost 50 years. Money alone is rarely enough to help motivate anybody to do something. But when you start talking about your charities, when you start talking about travel, we got a client here. This is a picture of Italy right here. When you start thinking about what you intend to do, how you want to live, just make sure that you're getting with your wealth advisor and your tax advisor and say, hey, do these things affect what I want my life to look like after my business sell? If so, then I need to be proactive and hands-on to go impact my business and make sure that I'm making it as valuable as it needs to be, so that when I eventually exit, it can offset these implications of the tax legislation. So, Lamar, a couple more of our forecasts here. Take us there, sir.
Yeah, I mean, like I said earlier, the profiles, I think a lot of buyers, as they shifted their profiles, saw some success. And they saw that, certain segments, reefer, for instance, was affected differently than dry van, was affected differently than intermodal, was affected differently than final mile. And so, we in the M&A space, there's been a lot of forever, conversation about client concentration as a risk and buying to mitigate client concentration. And what we're seeing is that owners and businesses are buying to mitigate segment concentration. So they're looking to own more of the supply chain and therefore, diversify the different segments and potentially because they move counter to one another. And same thing kind of with warehousing folded in there too. So, a lot of you kind of in the intermodal space touch on the warehousing, and you've seen how as flow happens in and out through ports, that impacts your trailers, it impacts warehousing. And so, the niche of owning more of those is something attractive to buyers. There's also buyers are looking to own the next level of talent. So we're seeing buyers that are looking for either proprietary software. The transportation industry has been through an incredible amount of technology upheaval, and ELDs being the most broad-based, but that has triggered the need for other technology deployment. And so, it's the build it versus buy it argument. And a lot of folks are acquiring companies that they can bolt on existing talent and existing technology to optimize and create better efficiencies in their existing platforms. So, I think those the buyer profiles that we saw change through 20 are going to continue to be represented in 21. And then, burnout, we're going to see, we've always seen probably for the last 10 years, the growing or the aging population of ownership within the transportation industry. And so as margins continue to get tighter, whether there's need for technology or insurance costs or federal regulation, Spencer's question, are you asking your wealth advisor, your tax professionals, what do I need to do to make sure that I secure the right outcome for my family? And so that's triggering a lot of questions about what are my exit strategies. And we would totally encourage you to get the right advisors around you, helping you answer those questions. And then Spencer mentioned this, I'm not going to belabor it, but drivers drive deals. We have some buyers that we know that are on almost 100% capacity buyers. So they're looking for how many trucks, how many trailers, how many drivers, how many chassis, how many square feet of warehouse can I get my hands on? And so that's, they're just pure capacity buyers. Spencer, last round of predictions.
Yeah, so we'll make sure we leave some room here for some Q&A. Prediction number 1, 20% uptick in overall deal volume in the transportation logistics space. Some of that's going to be a little bit of carryover from what didn't happen in 2020. Some of that's just going to be related to, people throwing up their hands up, burnout or age or whatever, just ready for a change. Second prediction, valuations up 10% for companies with 50 million plus in revenue. Eric talked about this diversification plus talent. People are going to invest aggressively in diversification, and they're not going to take risks that they don't have to. And to do that, they're going to pay a premium to get the best talent that comes with the transaction. And so having those leadership teams in place is going to be key. And it's much cheaper in the eyes of the buyers that we visit to pay for that premium rather than to roll the dice and hope that you can figure out on the fly. It's just not going to happen. And then this last one, valuations remain flat for companies less than 50 million in revenue. You see that asterisk there. This assumes that companies can offset the growing challenge of rising costs of doing business in this space, specifically insurance. I mean, if you're not able to offset those, then that's just going to dollar for dollar decrease on the value. But assuming that can be done, there's still a high market for even companies 30 to 40 trucks because of drivers, because of capacity for a variety of different reasons. There's going to, and because of the growing pool of buyers, people need it. And so that's going to be there for folks, a much smaller profile than what we experienced 3 to 5 years ago. I
think that's a good point, Spencer, to kind of validate that 50 million is not the magic number. It's kind of an internal number we use because what we're really looking for is, have you reached the critical mass to have the leadership, the management, the kind of that critical mass that our buyers looking for? So that sometimes that happens at 30 million. Sometimes you have a $70 million company and it's just one guy making all the decisions, and that's a risk. So the 50 million is not the magic number, but it's really a threshold we see as that critical mass of management talent, that technology type of thing. So
perfect. Yeah, absolutely. All right, so we got a couple takeaways here for you. Number one, update the exit and impact goals. Get with your wealth advisors. Make sure that what your business can command in the market can actually create the experience that you want post-transaction, whether that's next year or 10 years from now, and make the appropriate adjustments. At Tenney Group, we're super passionate about owners being in best practice groups. So I just want to encourage you that there's tremendous opportunity, but also the cost of making mistakes in this industry is just super unforgiving. So don't be a lone wolf. Lock arms with people, get in the best practice groups, and just go do great things. Update your buyer profile. If you haven't already with us, we've literally had hundreds of buyers that we've done business with update their things. We want to know what's going on. If you want access to opportunities that actually match your updated strategy, make sure that you've provided us that information. And if you haven't already done so, we did a more extensive M&A recap and forecast. It's right on our website at www.tenneygroup.com. It's free, and it'll just build on what we did today. So with that, we want to thank you for, we know your time is valuable. Thank you for investing it with us, and happy to answer any questions that we can with the rest of the time.
Outstanding, guys. Thank you so much. That was great. I was taking a lot of personal notes as well as notes to try to loop into Q&A, because I think it was just such a lot of great salient information that I know is going to resonate with a lot of folks. I was taking a peek at who we had on for attendees, and I know for a fact a lot of those folks are they're right in that sweet spot of the companies that you were talking about in terms of looking and whether they decide to move to become move into the acquisition mode or consider putting themselves up for acquisition. So there's a lot of interesting stuff there, and I would definitely encourage folks to do get that full M&A recap, because I think it's great background as you kind of process through this stuff and move into the year, to just kind of get a deeper dive into that. But you guys did a terrific job of giving an overview for folks. So many thanks. We've got some good questions coming in. Here's one about EBITDA to kind of get us started. What are the different inflection points for EBITDA size which increase multiples, i.e. 3 million, 5 million, et cetera? Is it different in different industries? And what's the consensus on how size impacts multiple variables?
That's a good question, Hal. And also, if you want to sell those containers behind you, I can find a buyer for you if you're interested. That's a great question, something we get pretty often. And I think the answer is no, or yes, whichever answer you want, because it's really doesn't, the EBITDA number is not the driver of the value. I think it's more of what Spencer was saying about scale usually means they have the components in place that drive efficiency and value. So the reason people ascribe EBITDA number to a higher multiple is not necessarily just because of the financial efficiency, because it generally means that once they've reached that $5 million EBITDA, say they're doing 50 million in revenue and $5 million EBITDA, well, then it goes back to what Spencer was just saying. They probably have put in place technology, people, management, safety, all the components that really drive a successful, valuable target for an acquisition. So, if you use that number, we just used a 50 million, and you pull it to the EBITDA, maybe 5 is the number. But again, that number represents something that's baked in, that's not really just about it's not just about the number threshold. So Spencer, do you have anything that would color that even more?
Well, I mean, I think in general, in a low margin industry, scale matters. So I do think that depending on who the buyer is, without scale, it's very difficult for them to capitalize on all the available technology that would be implemented post-transaction. So I do think that there's there are general thresholds that the higher the business, all other information the same in terms of leadership, technology, all the processes in place, that the larger the business, the greater their impact, the greater the economies of scale, they're more likely to receive a higher multiple.
That makes sense. And this one's kind of riffing on it, and you sort of touched on it, but although all deals are different, would you say that for a buyer looking to acquire a company with a $1 to $2 million EBITDA, that there's a general kind of go-to template of sorts, kind of a starting framework?
It's a great question too, because that 1 to 2 EBITDA number is really on the smaller side, and it probably represents what Spencer was saying at the very beginning, which is the under 100 truck deals that don't get publicized. It's usually their buddies in the industry, right? And Sally says to Billy, or Billy says to Freddie, hey, I want to retire. Let's structure a deal. Okay, well, let's take your $2 million EBITDA, multiply it by 5 times. We'll give you, 2 of those X's right now, and then the 3 of them will pay out over 3 years. And that's very, I think, common for for a handshake type of deal. It's not as common if you look at the stats that Spencer alluded to early on. What we see in our deals are the cash is more 60 to 70%, both for strategic and financial, with the earnout being closer to that 30%. So on deals that are marketed, then we see more of a cash component. And again, we've done deals in that size. We've done many deals in that size. That's again on the lower side, but that's we would say it's not crazy. I don't think that's a bad place to start, but our data says that the cash is stronger on the front end, just in terms of the deals we've seen in the last 18 months. But a 4 to 5 times is a decent, conservative starting point in terms of multiples.
Thank you. Here's one. Has financing for acquisitions been largely available? And if so, is it bank or non-bank financing?
Spencer, you alluded to one deal, but do you want to take that one?
No, I think that in terms of a look back, it's certainly disrupted as far as just cash flow lenders that traditionally play a major role in how deals get done. But in substitution of that, you saw the equipment financiers step into that. Now, obviously, with our audience here, there's a mixed bag of a lot of people that run asset light and whatnot. So really, in terms of the financing, depends on what assets do you have available to help facilitate that financing. So if it's complete asset light, you don't own anything, then yeah, there are limited options, and that would be true in any environment. And so, to the previous question, that's where you kind of see that a little bit more common. If there's no assets available to finance, then yeah, you have to get a little bit more creative about bootstrapping that. But in general, right now, when there's available assets to contribute to the formula, it's an aggressive market. It's highly aggressive, even just in terms of people. Once the financial markets got their bearings, September, October, it's been highly aggressive since then.
Yeah, as Frank Sinatra would say, and he cleaned that up. It's been here's a good one, talking about regionality. So the discussion hasn't really touched on regional versus national service differences. Are there, generally speaking, regions where there's been recent, current or projected greater buying demand given the deal data breakdown, or for regions where there's greater or less appetite for transaction?
Yeah, I think that, I mean, there's definitely some data if you look at just kind of geography, but more anecdotally, because of uncertainty around California, there has been less interest in ports that are, companies that are based in California. Folks, continue to run maybe freight through, or, but not necessarily domiciled in California. So that would be one of the, kind of talking to buyers. I talked to one yesterday and they were like, nope, nothing California. So that's, we can't see that. That doesn't mean that there's not any deals done in California. It just means there's a little bit of sensitivity. That would be a regional deal, but we've done any number of deals where a buyer is very dialed in regionally, and that's where they want to stay and they want to grow their density in that, or they exist in a certain region and they want to extend that density. And so we talked to one a couple of weeks ago that they are very strong in the Southeast and the Northeast, and they want to move west. And I talked to one that's, strong in the Southeast, and they said, we don't want to go further north than X and further west than Y. Like, perfect. So regionality is definitely something that we see a lot of, depending on whether our client, the seller, where their density is, and then that helps us. What we do is we try to we don't just blast out information to everybody in transportation. We whittle down a very tight list of people that we know can get a deal done, and we know that would be interested in this. And so, if you're in California, we're not going to take you to somebody who's physically told us they want California, but we're going to take you to somebody that we know already has operations in California. So that's where the regionality really comes into play, is when you dial in the specifics of a deal and making sure that we maximize the outcome.
Yeah, no, that makes loads of sense. I think it really tracks with the logic of how folks are approaching it. A lot of it's sort of, what do you have stomach for? Right. Here's one on the pandemic in particular, but I think it's a good kind of overarching question about the role of cross-border players. And have you seen sort of an increased or a decreased appetite in looking at companies that specialize in cross-border, whether it's the northern side or the southern side?
Yes. I mean, just in the last week, we have a client that has cross-border to the south, and we've begun having conversations with potential buyers. And then I had two conversations last week, one with a buyer out of our buddies to the north, and one as a potential seller, north of the border. And so, I think, again, it's a risk play. Folks that, kind of what Spencer said, if it's a private equity group that doesn't have transportation, we're not going to take them to a cross-border deal right out of the gate, because it's even more complex. I have a friend in the industry that has written a lot of cross-border insurance, and he's given me some tidbits of how complex it could be just to get the insurance dynamic with different driver components. So is there interest? Is there a heightened amount of interest? Yes. Does that mean we're going to see more deals? Potentially, but I wouldn't stake it on, because it takes a special buyer that knows what they're getting into, to make sure that they're going to get that deal done the right way. COVID it's just adding complexity and uncertainty to taxes, PPP, cross-border, all of those components just add levels of uncertainty. Uncertainty means risk. Risk means you have to be more dialed in on to get a deal done.
That tracks with what I was thinking, but I think great perspective, especially since you've got kind of fresh data coming in all the time. And here's one that, just to kind of riff a little bit on what you just mentioned about insurance. We've been tracking the issue that we're affectionately calling the nuclear verdict issue, right? Which is particularly motor carriers are getting eaten up by exploding insurance costs because of just out of control claims. Just they call it nuclear verdict for a reason, right?
Sure.
Have you seen that having any overall impact on deals?
100%. I mean, well, the first question that we ask when we're taking an assignment on in our team is, when's your insurance renewal, and what's it going to be? Our clients, they know. I mean, in general, they have a relationship. I mean, those insurance solution providers, they've been in the trenches with them for a long time. So really what that does, it indicates to us the runway that we have to go get a deal done, because unlike what we've talked about with some of the non-reoccurring performance dips associated to COVID, like that's a permanent deal. So like when a buyer's looking at, okay, the insurance premium just went up, these are risks. And so what we're trying to do is to get out in front of those renewals so that we can market the business when we have the best information that presents the business in the most positive light. The challenge is, and how it affects deal making, is that's part of the due diligence. They want to know what risk are they assuming and how's that going to affect the premium. And that's why we have industry experts in our network to help us navigate through that during that process, so that we don't fumble late in the game because we don't know what this is going to be. Yeah. So the main thing is that it's a real risk every day that you put your truck on the road, that you know, that type of nuclear option is out there. And so, you know, our deal from our clients, once they determine that they want to exit, we want to get them off the highway as quick as possible, so that exposure is no longer there. Because, you know, when you start talking about 50 to 100% increases, it's, for some folks, particularly in that 50 million and below, it's kind of game over at that point. It's very difficult to get something done once that premium's in place, beyond just selling the business for the assets themselves.
Yeah. Yeah, no, that makes good sense. A couple of other things came to mind, but in terms of seller financing, when you kind of enter into a deal and you're looking at that as a component, you know, kind of what are the pieces that come into place to kind of put that part together for folks?
Well, it's a great question, because it is a component that we've used, and Spencer's talked about it. We've both talked about it. It's a risk component, right? It's a shifting of risk, right? And so again, M&A is not just about the financial outcome. It's not just about, you know, the buyer's need being met, but it's really a risk evaluation of the deal getting done. And one of the ways that a buyer can hedge their risk is to tie some of the seller's, you know, total compensation to long-term success of the new entity. And so for a seller, for our clients, a lot of the questions, you know, it's like, it's not roll forward stock, but it's similar, right? So you're keeping a component, you're keeping a debt instrument that's, you know, that is funded by and a lien, quote unquote, against the buyer company. So we want to make sure our client is comfortable with the acquirer, that they're comfortable with the post-transaction plan of how the integration of their company is going to go into the larger company. Spencer mentioned control components. Are there pieces of the success that our seller or our client has a role in going forward that can add a level of confidence to them that they're going to be playing an active part, and so that, you know, it's not just sign a seller note and then hope for the best. You know, those are some of the components. Spencer, other color to add?
A couple quick takeaways, and I hope if you are involved in a transaction right now, I think this is something that you'll appreciate. The biggest thing that we try to equip our clients with the knowledge is that you're the bank, which means that, like, you set the conditions under which you make financing available. So as long as you're not dealing with only one party, this is, you know, what it looks like is you have some options. If you're going to extend that credit, much like a bank, it's, you know, it's completely reasonable for you to have credit references. So for the people that you're dealing with, if they've done acquisitions before, you need to be asking, as a condition of close, I need to check your references. Are your former people that you've done deals with, if that involves seller financing, are they getting paid on time? And how is that experiencing working out? And so when people do that, number one, they get more comfortable with the fact that, like, hey, I'm not going to close the door on seller financing because I'm scared of it. No, like, you control it. So as long as you understand how to work through that and protect yourself, only you can extend it to the person that makes sense for you. And so the worst thing you can do is just shut the door on and not make that as a possible instrument to get a deal done, because you're just going to leave money on the table unnecessarily. So as long as you have control over who it is and you check their credit references, it can be a great way to expand the scope of what you walk away with at the closing table.
That's a great overview of that. Super helpful, I think. You know, one of the things that we've touched on, I know you guys work in transportation, but that's sort of, you know, there are a lot of Venn diagrams that make up transportation. So I know you've got a lot of experience over the years in not every company is simply a motor carrier or a 3PL or a warehouser, right? Like you've got some that are all and some that are pieces and puzzles. Are you seeing, at least from this past year's wacky experience, are there more deals happening in the motor carrier space or the 3PL space, or kind of pulling in warehousing?
That's a good, I meant to say this, Hal, so it's a good question, because one of the things we've also seen in terms of diversification, acquisitions leading to diversification, are traditional truckload or traditional asset heavy companies acquiring 3PL or brokerage or asset light targets. Again, that's a diversification play. They're diversifying their risk, they're diversifying their offerings, and particularly in the brokerage to asset bolt together, there's the optimization of their existing fleet that asset heavy or traditional truckload, traditional carriers are motor carriers are looking to achieve. So we are seeing, to answer your question, we're seeing more motor carrier, more operator of asset heavy or asset light motor carrier type of deals being done. But the trend is that the growth is coming more in the asset light and the 3PL. So if you talk about percentage of number of deals done year over year, it's growing in number in the asset light and 3PL and brokerage space more than it is the asset heavy traditional truckload. But there's still more deals done in the traditional truckload just because there's more of them, right? And there's a more of an aging population. There's more, again, we're all familiar with the 3PL, the brokerage tend to be a younger ownership pool. And so that's, they're not necessarily turning over because of retirement issues. They're turning over because they want to, they built something they want to get out, or they built something they've reached. Particular 3PL or brokerage, there are different thresholds we've seen, 10 million in revenue, 20 million revenue, 50 million revenue, and then like 250 in revenue that are different pain points. So it's like it's relatively easy to get to a 10 or 12 million in revenue, but then to get from 12 to 20, there's some pain points. To get from 20 to 50, there's some pain points. And so to get from 50 to 250, there's pain points. And so what we're seeing is that, again, the buy it versus build it is a truckload carrier may be willing to buy a 20 or $50 million revenue broker, bolt it into their existing truck line to optimize their fleet, and then give the broker the bandwidth to grow that piece inside the business as well as outside, brokering other freight. So a really long answer to your really short question.
Very long.
That's great. No, it was super, because I was going to ask one about assets too. So you kind of you read my mind. I think before we close out, there's a couple of things on confidentiality that I think are important to touch on, because I think it really, a lot of times, a lot of our members are, they're small companies that they built. A lot of our members built their companies, and they maybe want to explore the market, but they don't want to just sort of throw open the doors and have it be a open house, right? So do you have any advice on potential sellers exploring the market while maintaining confidentiality and not hurting themselves?
Yeah, I would say that this is another takeaway that kind of goes along with that seller financing deal. We do a seminar specific to this, and this is a very specific takeaway. Number one, call to action is go develop a teaser, which is a one-page summary. What ends up happening is people, hey, I'm interested in it. Can I have everything that you've ever done and all the information about your business? And it's not like they're not even, most buyers, they're good natured about it. They just don't know that they don't need all that stuff to determine whether or not it's going to be a fit. Yeah. On a one-page summary, they can determine pretty well whether this is going to be a fit or not. And a seller or a business owner can supply that without feeling like they're totally exposed and vulnerable. So step one is go develop a one-page summary that can blindly protect yourself. Here's the highlights of the business, 3-year history, questions about the drivers, are they IC, are they employee-owned? And there's some other investment highlights that you could do. And this would prevent you, number one, from an efficiency standpoint, trying to run down all this information that's probably not going to matter anyways.
Yeah.
But number two, here's what's important. Just by having that, it already conveys that you've been here before and that someone's asked for it beforehand. So it already kind of conveys that like, hey, I'm already being sought after. I'm prepared. I'm accustomed to this. So here's what it is. And this is the process for what that looks like. And you don't need that. You don't need Tenney Group to be able just to protect your time and resources. And this to tell them like, hey, based off this one pager, why don't you just provide me a non-binding range of offers in the form of indication of interest to see if you might be of interest. Number one, most of them aren't going to do it, and you'll save a ton of time. But for the ones that are, I mean, you've already hyper accelerated the process. The other part of that is once you do get involved, and if you're more interested in exploring multiple offers, that's when it becomes a little bit more sensitive, and that's where we use blind teasers. We require confidentiality agreements. But the deal is this: our team we're always trying to disseminate information in increments. Never do we give everybody all the information about the business. It's always qualified based on how deep we're getting into the transaction. And the biggest thing is money. Hey, until we kind of determine that we're in the same universe, if everything that you hope is true about this business is true, what's the money going to be? Mm-hmm. And I think that the sooner that's where we come in terms of kind of forcing that issue in a very efficient way. And the deal is once we do that for buyers are like, thank you.
Yeah,
that's going to help me too, because I want to know just as badly as the seller wants to know whether this has got legs. So like it's, this is something that adds value to all parties. And in some ways you can do the first part on your own. To do that next level, that's kind of where we come in. But at least for now, you have a very tangible takeaway. Go implement.
Yeah. Hal, I'll give you a funny, this happened this week. We're in conversation with a potential seller, majority owner, and their kind of key leadership, had several conversations. And then probably 36 hours later, another member of the family called us that we've met at another event, whatever, and said, hey, we want to talk. And so we're literally talking to different parts of the same organization confidentially, not letting the others know, because that's part of our job in terms of protecting company. So it's a real, this, as we all know, the transportation world is really small. And so that is a very high priority. If these are conversations that you are wanting to have, make sure you're thinking very proactively about the confidentiality dynamic.
Yeah, no, that makes loads of sense. And that's why I think guys who've been doing this their whole lives, and it says something when you put your family name on your company, right? It means you stand behind it. It's important both for everybody, including when you need a partner to help you navigate these waters. One last thing I want to sneak in before we wrap up, which is kind of flipping that around. If you got somebody that wants to explore the buyer market, they're like, you know what, I think I'm ready to grow. Like, we've done real well in the Midwest. We want to take a look at the Gulf or whatever the scenario might be. Do you have any sort of key advice for a potential buyer getting into the market?
Spencer, that's another webinar Spencer's done. So take it away.
Awesome.
Yeah. I mean, I think number one is I think Simon Sinek has this thing as far as like know your why. I think that's where a lot of buyers misuse a lot of times. Like they don't know. They get out there and they start having conversations, and they haven't yet, as a board or as a leadership team, decided why are we doing this. Yeah. I had a guy that in the Midwest came to me, he had 400 trucks. He said, Spencer, hey, I want to grow. The next 5 years, I want to go from 400 trucks to 700 trucks. You're my guy. Let's go acquire some businesses. Let's go gangbusters. Let's do this. And I just said, John, okay, I'm happy. I'm excited. But before we do that, how is that going to make your life better? And he's like, you know what? I hadn't really thought about that. I just love trucks. And so, number one, I would say that the best people, they have a very specific vision and a purpose about why they're doing it. And number two, they have a very specific profile about who's going to address that need. Way too many people say like, hey, just give me something anywhere in the Western United States that has more than, 50 trucks and I'm interested. And I was like, and then our practice is you're going to have to think through a little bit more than that, because you're going to waste our time. You're going to waste your own time. Really think through what's the profile. If you could get one company, what's the best immediate impact? What do they have to look like in order to do that? And when you can kind of go through that exercise, it's going to save you a ton of time and resources looking at deals that you're never going to do. Yeah. So that would be my advice to that. And the third thing would be, obviously we talked about make sure you have your profile list, but just don't place any limitations. I mean, you never know. So many people say, I can't do that, or I'm not capable of doing that. Believe me. if you want to, there's a way to get it done.
Great. That's super. I really appreciate you sharing all this knowledge and bringing this really important information at a critical time to our members, because I think they are really looking at this very seriously. I do want to harken back to one point you guys made about leaning into your colleagues and getting into affinity groups and, reaching out to guys like you, obviously for the professional advice, but also, working with your colleagues. I learned one thing from Dave Manning of TCW, former chairman of IANA, and a great guy, and, mentor to many. And that is, that's kind of been one of his mantras that really stood out on something that you guys said, and I wanted to share. So many thanks. I would encourage everybody to reach out to Spencer and Eric at the Tenney Group for more info. Definitely head over to their site and check it out. There's a lot of great information there, including that M&A recap. And head over to intermodal.org for more information about IANA. We will have a full calendar of our forthcoming events up soon. And that will include, as I mentioned, I kind of teased it a little bit, but we're going to be doing 3 more sessions with Spencer and Eric on other related topics that I think we'll dig into a lot of these things that we've touched on a little bit deeper. So I'm really excited about that, and it'll make for a really fun year. So with that, thank you, gentlemen, for your sponsorship, for spending your time today. Thanks for all the folks that attended and hung in there with us. A lot of great questions. And with that, I will bid everyone adieu. Please stay safe. Keep doing that great work to keeping our economy moving.